choose tax-free accumulation, access, and multiplied transfer of your money. In this episode, I'm going to address the question, what are tax-free investment options? I've been asked this question thousands of times in the 46 plus years that I've helped people optimize assets and minimize taxes. And I share with them my favorite vehicle that allows me to accumulate, access, and transfer my money totally tax-free. It's probably not what you think. Get ready to be blown away. You're going to learn some things that I teach CPAs and tax attorneys in America for advanced continuing education, and they sit there with their mouths open. So you're going to have some aha moments here in the next few minutes. My name's Doug Andrew, and I've helped people understand how to optimize assets but minimize taxes for more than 46 years. Many times I teach advanced continuing education because most CPAs and tax attorneys have to have every couple of years like 200 hours of continuing education. So my courses are qualified for that, and they come through and they sit there with their mouths open because they didn't need to learn what I'm teaching them to become a CPA. They didn't need to know this to get their LLM degree. What's that? A master's in taxation as an attorney. And they go, well, I've heard of these tax laws. I've heard of these sections of the Internal Revenue Code, but I never did understand them. Doug, you made them so clear. Where have I been? I think we've been advising our clients wrong. I go, well, I wouldn't go that far. It wasn't wrong advice. You've been telling them to sort of follow the herd and put their money in IRAs and 401ks. It wasn't the best advice. You know that now. It was maybe good advice, but it was a far cry from the best advice. And they go, you're absolutely right. I don't know if I want to go back to my clients and show them the best way because I'm the one that told them, oh yeah, do an IRA or 401k in the market. Well, I said, if you don't tell them, somebody else will. So you ought to go back and say, hey, I've learned about something that's better. So when people ask about tax-free options, first of all, I want you to understand the difference, dramatic difference between taxed as earned investments, tax deferred, and totally tax-free. And then you'll understand why tax-free is the way to go. So most people in America save the absolute worst way. They have their money in taxed as earned accounts with banks, credit unions, even mutual funds and so forth, where every single year the institution gives you your interest that you earned on a form. You have to report it on your tax return. So you're paying taxes every year on your earnings. Let's say you started out with $1. Now, $1 doubling every period for 20 periods, $1 goes to 2, to 4, 8, 16, 32, 64. Do you know after 20 periods of $1 doubling, $1 will be worth $1,048,000 if it's tax-free. If it's taxed as earned like I just described, in a 25% tax bracket, most Americans pay at least 25% in taxes between federal, and if you live in one of 41 out of 50 states that has a state income tax, you'll pay at least 25% in tax. So if $1 doubles to 2, you pay tax of 25%. That's only 25 cents. You got $1.75 left after tax. Now the $1.75 the next year doubles to $3.50 and you pay tax on that. Do you know what you'll have at the end of 20 periods instead of $1,048,000? Only $72,000. If you're in a 33% bracket, you'll only have $27,000. Only 2.7% of what you could have had. Most people don't understand this. And they just put their money in banks and credit unions and pay taxed as earned on their investments. Now, some people thump themselves on the chest and they go, I have my money in a tax-deferred IRA. My 401k is tax-deferred. Look, my dollar has doubled. 20 periods is now worth $1 million and it's $1 million. I go, well, it's only tax-deferred. That's not all your money. See, you agreed that the government now gets their portion on the back end when you retire. And so that's not your money. A third of that belongs to the government when you take it out. If it's earning 9%, let's say, A million earning 9% is 90 grand. You pull out that 90,000 of earnings, you're only netting 60,000 because of a third of it is going to go out the window in taxes. And so the million isn't all your money. Only 2/3 of it, 660,000 of it is your money. The rest belongs to the government. If people go, well, golly, I was really hoping on my $1 million nest egg to earn 10% or 100,000 a year. And they pull out 100,000, but they're not netting 100. They're only netting, 67,000. In order to net 100, they have to pull out 50% more money. See, in a 33% bracket, you have to pull out 50% more. What's 50% more than 100,000? 50,000. You have to pull out 150,000, pay tax of a third 50 to net 100. Do you know the $1 million nest egg will be gone, drained dry in 11 years? So my favorite vehicle is totally tax-free. Because if I have $1 million that's totally tax-free and I'm earning 10%, which is what I have been earning for the last 27 years, on the average 10.07 to be exact, I pull out 100 grand and it's tax-free. If I pull out 100,000 and I net 100,000, my $1 million nest egg stays there. I still have $1 million in 11 years. If my wife and I, one of us, make it another 20 years to age 96. When the person with $1 million in IRAs and 401ks has been living on charity welfare, their children for support for the last 20 years, they ran out of money at age 76. I still have 100 grand of income for another 20 years, and I still have my $1 million at age 96. An extra 20 years of 100 grand is $2 million, and I still have my $1 million. That's a $3 million better retirement nest egg on the same amount of money, assuming the same rate of return of 10%. And by the way, most IRAs and 401ks don't earn 10%. I'm giving them the benefit of the doubt. That's a $3 million better retirement nest egg. How many of you watching this would like to have a $3 million better retirement nest egg? Yeah, hello. I do that by using max-funded indexed universal life insurance contracts because that's where I have earned an average net cash on cash internal rate of return after all costs and fees of slightly over 10%. And by doing that, it means that I'm able to accumulate my money tax-free. Now, this is why I've helped many people reposition assets out of yet to be taxed IRAs and 401ks, get the taxes over and done with sooner than later, over maybe 5 years, and get the money out of the market. Get rid of that market volatility. Because too many people are too top heavy in what I call the investment bucket that they have to pay tax on the rest of their life. If they string it out or take required minimum distributions or whatever, worst advice I've ever heard, RMDs, and they leave it there. No, you want to get it out over into the tax-free bucket. I would recommend between 40 to 60% of your money be totally tax-free. There's basically 3 choices there. Municipal bonds. They're low yielding, and a lot of municipalities get into trouble financially and have to file bankruptcy. So I've always earned a rate of return of 2, 3, 4% higher than municipal bond rates at any time. Roths. Now, Roths are a step in the right direction, but there's too many strings attached. You can only put in a certain dollar amount, a certain percent of your income, and you have to leave it there for 5 years or till you're 59 and a half and blah, blah, blah. And so Roths only have 2 advantages. You fund them with after-tax money. It accumulates tax-free, and you can take it out tax-free. My favorite vehicle, a laser fund, has those 2 benefits, always has for over 100 years. It's been grandfathered in the Internal Revenue Code under 3 sections, 72E, 7702, and 101A. But see, my laser fund, my max-funded indexed universal life contracts, they allow me to put in huge lump sums. You can't put in 300 grand into a Roth unless it's a one-time rollover. I can put in 300,000. If I don't, I can put in, let's say, just 30,000, and I can make up for the other 270,000 anytime I want. You can't do that with the Roth. Once you don't use the room in a given tax year, you've lost it. If I put in 300,000 and 30 days later I want to pull out 250,000 for an emergency or an investment, I can access money at any time for any reason. There's no penalties. You can't do that with a Roth. I can use indexing, so when the market goes up, I get to benefit, and I've earned 16 and 25 and even 55% some years, but when the market loses, I don't lose because my money is not in the market. It's safely tucked in the insurance company, and they are simply paying me whatever the index that I choose because they know how to buy options, so they're not out anything, Because if the market loses, I may not make anything that year, but I don't lose what I started out with at the beginning of the year. That's called indexing. I get to use that indexing strategy, but why do I like the laser fund, the max funded IUL? It's because it's the only vehicle that blossoms when I finally die. I'm 68. If I died tomorrow in an accident, every million would blossom to about 2.5 million and transfer income tax free to my wife, and then to my kids, and then to our church. There's not a Roth around that will do that. Why would I ever own a Roth? I never have and I never will. When I can have the 2 benefits of a Roth and 4 additional benefits Roths will never have. So when people say, what are tax-free investment options? Basically 3: municipal bonds, Roths, and max-funded indexed universal life insurance contracts, which I call the Laser Fund. LASER is an acronym that stands for Liquid Assets Safely Earning Returns. And by far, that's my favorite vehicle. I've helped many, many couples who had $200,000 of annual income out of their IRAs and so forth, and it was all showing up on their 1040 tax return. And in less than 5 years, I took $120,000 or more of that off their 1040 tax return. The IRS knows they're receiving it, but they know it's tax-free. It's not even worth auditing. This has been grandfathered and protected in the Internal Revenue Code for over 100 years. If you did the math from what I just said, they went from a $200,000 taxable income down to $80,000 because I moved $120,000 over to the tax-free bucket. They would have paid taxes of 1/3 on that 120. That's $40,000. If one of them lives 25 years, I just saved them an extra $1 million of unnecessary tax by moving money over to the tax-free bucket in the Laser Fund, earning higher rates of return than the average place where most people put their retirement assets. If you want to learn more, this is why I'm an author. I've written 11 books, and many of my books address this, but my most recent book is flying out of our warehouse, okay? Hundreds of books a day are going out. It's titled The Laser Fund: How to Diversify and Create the Foundation for a Tax-Free Retirement. This is curriculum actually for some of these CPAs and tax attorneys, but it's written on any level for you to understand. There's charts and graphs. If you like to learn by stories, you flip it over, and there's 62 actual client stories. Now, this retails for $20. This isn't about selling you some book. This is about giving you the information. I will pay for the book. I'll buy the book. You simply claim your free copy by going to Laser Fund, L-A-S-E-R, laserfund.com. Simply pay $5.95 shipping and handling. That doesn't even cost the shipping and handling, but that doesn't even cover the shipping and handling, by the way. This is like, I want to get the information out to you, and I'm very, very blessed to be able to do that, because a lot of people then want to listen and learn, watch and learn, and get educated. I'm into empowering you with education, because once you learn what you can do to protect yourself and what are the best tax-free investment options, you'll agree with me, a maximum funded indexed universal life insurance contract, if it's structured properly and funded correctly, will knock the socks off of any other options that are out there. I've benefited from this, and I want you to benefit also.